Hey there, everyone. Happy Tuesday and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a beautifully sunny and warm Redmond, Washington. It's April 23rd. Interesting day yet again in the market, seeing more accumulation, the beaten down areas from the last couple weeks, particularly technology, communication services driving higher. And this is leading into a bunch of earnings from those particular sectors. We've got four of the quote-unquote Magnificent Seven reporting here in the next day or two. Tesla happening right after the close here today. We're going to look at the charts together and see what sort of lessons we can draw from today's action. Great guest today, by the way. Bret Kenwell of eToro is going to be joining us for the first time with some weekly charts. I'm excited to talk to him about is looking at longer term, versus shorter term evidence in this particular type of environment. How do we reconcile short term versus longer term trends? I think I'll have some really good ideas along those lines. With that in mind, let's go to let's go to the market recap, that is, and focus on how the charts have evolved. Before we get there, by the way, we do want to start with a poll. We asked you recently on our social media platforms, will gold be higher or lower 1 month from today? 59% of you saying higher, 41% of you saying lower. That 1 month time frame is a tough one, to be honest with you, for a lot of people. I'm going to bring up the GLD just as a way to show it. What's interesting is as we're asking this question over the last two sessions, we had a gap lower on the GLD. Spot gold, of course, gapping lower as well. The GLD finished today just slightly lower, around 215, but that's down from over 220 at the end of last week. So this week so far has been sort of a contrarian move, I guess a counter trend move from what we saw the week before. Last week it was about the resurgence in energy and basic materials, the drop in leading growth names sort of going into this week. So far this week, it's been the opposite. You're seeing things like GLD, crude oil related stocks, energy gapping down or trading lower. You're seeing growthy names bouncing back to the upside. Really interesting setup going into sort of the meat of earnings season. It's interesting. If you ask me, I would probably say higher, but boy, it's tough right now. It sort of looked one particular way before the gap lower. I think on the GLD, on the tactical time frame, the fact that we're holding 215 is pretty encouraging. I think we start to break that and get down more toward the 50-day moving average. This is a pretty, concerning sort of development. Overall, though, in terms of multiple time frames, keep focused on something like the RSI. If we do get more of a pullback, I immediately start to look down at the RSI to see if we hold above 40. That's what kind of kept you in things here in February. See, we dipped just slightly below it, but overall making a new low. We pop higher, and the RSI really didn't get down to the oversold region. That usually is pretty an encouraging sign because it suggests that there's not a lot of negativity during this downdraft, and you're seeing some accumulation come in out of that new low. And we've now had a pattern of higher lows going into April. So right at a key point, I think for the GLD 215 is the level I'm at. We're sort of right there. I'll see if it's able to hold that key level of support. Continuing on here with our market recap, looking at the market overview on our dashboard, you can see a lot of green on the equity indexes. The S&P up 1.2%, finishing the day just above 5070. The NASDAQ composite finishing the day just below 15,700. That's up 1.6% from yesterday's close. Mid caps up, small caps up almost 2% higher. That's leading the way to the upside. The VIX, the only thing down today, still above 15, but coming off. We're a full point and a quarter, we'll call it, in VIX points down from Monday's close. So volatility coming down through the course of this week, still elevated, right? So we're still sort of in the upper end of that low volatility environment. For me, VIX between 15 and 20 is kind of classic pullback range. VIX below 15 is low volatility uptrend. VIX above 20 is watch out. And we haven't had that watch out signal just yet, right? We sort of traded up towards 20, but not really getting above there this week so far, coming off. So it's interesting that the trend going into a lot of earnings from a lot of growth names, the growth-oriented benchmarks pushing beautifully higher off of the recent low on Friday. Volatility coming off through the course of the week will be interesting over the next couple sessions if that continues. And if so, I would say the chances of us regaining the previous highs and going further probably pretty meaningful, right? Because if those stocks are working and if the volatility is decreasing, that probably means we're in good shape. Looking at interest rates, a bit of a change here, but not too significant. To be honest, bond prices were relatively stable. The 10-year yield and 5-year yield came off a bit, but not too much. 10-year yield currently around 4.6%, a little bit higher for the 5-year yield. The long bond a little bit above there, around 472. And of course, the short end of the curve still fairly elevated relative to the rest of the curve. So we have that inverted yield curve. This is what the Fed will be working to address through the course of this year, as they've described. But they have also, as we remember, talked about being data dependent. We have a Fed meeting coming up here very soon in April into May. The question is, do we get any additional color? Probably low to no likelihood of any sort of change in rate policy at this next meeting, but it will be all about the comments and perspective about when the first rate cut may come, how many rate cuts are coming, that dot plot that the Fed governors and Chairman Powell tend to like to describe. The dollar index down slightly, we'll call it 0.4% from yesterday, but overall holding in there just fine. Gold prices down, the GLD down 0.25%. We already looked at the chart of the GLD. Silver about 0.25% higher. Copper prices coming down. It's interesting. I mean, some of my conversations in recent weeks have been on, attractive setups in the miners and gold and energy. Those sort of trades not working particularly well here this week, although oil prices did pop higher, so a bit of a divergence within the commodity space. The USO finished the day up 1.5%. Natural gas and gasoline prices up as well. Finally, cryptocurrencies, I would say choppy sideways at best. During the equity session here, you're seeing a rollover in Bitcoin over the last couple hours, currently just trading above 66,000, and Ether prices just below 3,200. Looking at the 11 S&P sectors, you can see almost all of them in the green. Communication services, technology, industrials, all up 1.4% or more, with comm services at the top of the list. And again, this is where we're seeing some earnings coming out here over the next couple days. On the downside, only one sector down, materials down about 0.9%, consumer staples and utilities, number 2 and number 3 from the bottom. Looking at the Magnificent Seven, and I did get some new ideas here. Four Horsemen has come up a number of times. The Crazy Quattro was a new one I think we got yesterday, so thanks for that. Keep the ideas coming to refer to, I guess, this evolving list of working list of leading growth names, whatever we want to call it, because most likely I would say if and when the market recovers, probably more when than if, there's going to be this group of stocks that probably do quite nicely. So let's come up with a good name before it happens if possible. But for the record, Netflix higher over 4%, NVIDIA having a decent day as well, up 3.7%, Meta up 3% as well. On the downside, Apple lagging behind, up about 0.6%, Alphabet, Amazon both up about 1.3% today. So not bad for that list of leading mega cap growth names. Let's look at a daily chart of the S&P 500, see how today's trading fit into this framework that we've been talking about. So, I would say what's interesting to me, I'm doing a lot of referring back to August of last year, and I will warn you right now, anytime I make that comparison, I am not telling you this is what's going to happen. Just make sure you follow that playbook because it's going to do the same thing. Unlikely it's going to be exactly the same. It could be very similar, right? And I think the benefit of looking at previous pullbacks in this sort of environment is just to get a sense of what has happened, what could happen, right? Think about some potential future paths and think about what that would mean. Like, what would the indicators do? What would my portfolio do? How would I manage risk or identify opportunities? What would I maybe need to see to recognize that the downtrend is over? Those are the sort of things that I would look like. And I think what happened here in August of last year was you had that initial move down after this beautiful uptrend, about 4 or 5 months long, which is kind of similar to the run we've had off of the October low. Then you had a big initial leg down. It took about 2 to 3 weeks, very similar to what we've seen here. We then had a quick counter trend rally of about 2 weeks, and perhaps this is the beginning of that. But then immediately after that, we start putting in a lower high. Instead of thriving back above the 50-day moving average, we stalled out and went back below a downward sloping 50-day moving average. That's what I would be looking for here during this sort of counter trend rally. And what I like to do is sort of have my initial label. This is what I think it probably is, and then just do not be afraid to change the label if the evidence changes, right? So if we make new highs, I won't call it a downtrend anymore, I promise. But for now, I see this as an initial move down. I see this as a counter trend rally back higher. Today was meaningful because we closed back above 50.50. That was an important level on the way down. When we broke that, I think that opened the door to much further downside targets. For me, 48.20 is the next level to look down. That'd be a 38.2% retracement of the way back down to the October low. But given the fact that we've already broken support, given the fact that the RSI went all the way down to 30, that usually happens in a bearish phase, not in a bullish phase. So for now, I'm seeing this as a counter trend rally. You look to see what sort of top may materialize, and then look to see how the momentum proceeds through the course of that rally phase that we may be in here. Now, again, this is for now, the next couple days, starting with Tesla today. We got a lot of companies reporting earnings, and not just in the mega cap growth names. We had a bunch of sectors represented today, industrials and elsewhere. So, keep an eye on earnings and recognize that those largest names have outsized impact on the markets. Let's look at volatility here very quickly. Just wanted to point out, as I mentioned, we're sort of in this no man's land between 15 and 20. A VIX above 20 I see as a dangerous sign. A VIX below 15 is sort of a thumbs up, all clear. A VIX between 15 and 20 is sort of a meh. It's sort of a wait and see mode. Pullbacks usually end up in this range. We saw that in August and September of last year. We're seeing that again here. See if the VIX pushes back below 15. That usually means potentially we're in a little better, more stable position. But for now, volatility suggesting we're still in a pullback phase here. I did a webcast earlier today on breadth indicators. I hope some of you were able to join me there. We went in depth through a number of breadth indicators there. And yesterday on the show, we did a segment banking on breadth where we went through those in a little more detail. So I'm going to jump forward to some of the individual stocks in the news, on the move, reporting earnings this week. Just things that I think you should maybe be paying attention to here. We're going to start with MicroStrategy. An interesting thing has happened here recently because you have two names, SMCI, which is super microcomputer, clearly breaking below the 50-day moving average, gapping below it on Friday, and now bouncing a little bit off of those lows. But MicroStrategy, which is currently the top-ranked stock out of the entire large-cap U.S. universe, is for now, I guess you would call it sort of toying with the 50-day moving average. It did technically close below it, but you never really got any follow-through, and as of today, we're closing back above it. So you have MicroStrategy, a name that has been an incredible gainer over the last 6 to 8 months. You see the RSI was very overbought. We see obviously a pullback to an ascending 50-day moving average. If this is that classic buy on the dips kind of pattern, that's about where it should bottom out. The stock usually pulls back to an ascending 50-day moving average. It has. The RSI usually pulls back to around 40. It did. And now the question is, do we get the recovery from here? I think a bounce from here really suggests this is an opportunity to ride a leading name that has pulled back quite a bit. I mean, this went from almost 2,000 to almost 1,100 in just about 2 to 3 weeks. I mean, it was a huge, quick, sudden downdraft. But now all of a sudden you're seeing a bit of a bounce higher. So RSI holding 40, this stock holding that recent swing low. I think that's the thesis here. If you're bullish, those things break. I think this is a dangerous chart. But for now, kind of in that classic buy the dips setup. So an important one to watch. Looking at the chart of Netflix, I'm going to switch to a chart style that I have called candle focus. This isn't an ideal Morningstar pattern, but if you know your candle patterns, this may look familiar to you. It's called a Morningstar candle pattern. Excuse me. A Morningstar candle pattern, if you're not familiar, is a 3-day pattern or a 3-bar pattern. You start with a big down day. You have this gap lower, and it's just a slight little gap, but it was one. Excuse me, and a bit of a trade higher during there kind of makes it a little more significant, I think, and then a big up day, day 3. So big down day, day 1, a sort of choppy sideways day 2, and then a big rally day 3, and there's a bit of a gap between day 1 and day 2. That is called a classic Morningstar pattern. It is a bullish reversal pattern. So here we had a gap lower and then this 3-bar bullish pattern. It suggests higher rather than lower, and there's kind of a natural built-in stop to that. You look at the low from day 2, and as long as we hold that on a pullback, it's still sort of in play. Overall, encouraging to see a stock like Netflix. This was an earnings name last week. This is when they, overall did fine on earnings, but just basically talked about how they weren't going to report subscriber numbers anymore, and the street taking that as a big-time negative because it implies that the company's assuming those subscriber numbers are going to be probably not as encouraging going forward. So the stock gets dinged very, very quickly, but now you're seeing that 3-candle pattern, which represents accumulation, shows that investors are buying in on that short-term weakness and betting on Netflix, maybe regaining that 50-day moving average. That's what I would look for, immediate resistance coming up. That lines up with the 50-day, but also lines up with a pretty consistent support level back from March into April. So kind of an interesting short-term setup there if you're more on the swing trading time frame. Let's go back to our normal chart and we'll look at Meta. When I'm looking at Meta, it's interesting to me that we're sort of in this sideways pattern here. We gapped higher in February, overall trading higher, but if you look, we hit 525 in March. We traded back up to that level and stalled out. And now we've technically bounced below the 50-day, but we're holding that 475 level. So that's this week's low. That's also a low from early April, low from mid-March, all right around that point. So I think Meta above 475, still a pretty decent chart. Meta below 475, RSI below 40, that's the danger sign. So if you're thinking of a stock like this, where to set an alert, 475, that's the level. Next one I wanted to show you was Spotify. And if you look at Spotify, this is one of those earnings names. We have a number of stocks reporting earnings either yesterday, today, and I just want to highlight some of those. Spotify came out. This might have been before the open today. I'm sorry, I don't have it in front of me, but gapped higher after the nice report. This is after testing the 50-day moving average yesterday. We gapped higher, but unfortunately, candle fans, this is a shooting star candle, and it's right as we go up to the previous high. Look at the doji candle on April 8th as we made a new high there. That suggested short-term reversal. Now we're getting a shooting star candle, which is a bearish pattern. So think about it. We gapped higher. We traded all the way up to almost 320, but by the close, we're back all the way down to 300. So it shows that investors were selling off of that initial rally during the day. UPS is another one I think is an interesting one to watch. Sort of take a step back from this chart, and you see sort of this consolidation. I probably label this a coil pattern, right, which is a pattern of lower highs and higher lows. This is what it kind of looks like. We have the move lower, and then you have this sort of sideways consolidating trend. The highs are getting lower, the lows are getting higher. So this pattern has to resolve, right, one way or the other. It either breaks above the upper boundary, which would mean it's back above the 200-day, back above trendline resistance, back above the March highs, or it's lower. It's not able to get above the 50-day. It breaks support, and it breaks the lower end of that pattern. I think patterns like this are important to watch. UPS might be an interesting indication of what stocks like this are going to do. It's really been sideways for the last 6 months. It really hasn't been going up or down. Let's see which way a chart like this actually resolves. For now, I would say open question, and a very bullish chart, arguably, if and only if it can get back above some of these key resistance levels. That's our market recap for today. Again, a lot of earnings to pay attention to. Make sure you use the earnings calendar on Stockcharts.com to stay on top of which companies are reporting when. And don't forget, the scanning engine can be very valuable to identify stocks on the move. Before we get to my guest today, Bret Kenwell, a couple quick announcements. First off, we welcome your questions. We're going to do an all mailbag show Friday of this week. We'd love to answer one of your questions on the show. Email, always best, thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. And here on YouTube, just put a comment below the video that you're watching, and we'll hope to hear from you, hope to answer one of your questions in our next mailbag episode. Also, we have a fantastic special happening right now. It kind of came out of nowhere, but turns out it's our 25th anniversary in April. How about that? 25 years ago, Chip Anderson created the domain stockcharts.com, started to program our first sharp chart version. Now has evolved into the beautiful platform that many of us know and use every single trading day. Now is a perfect time. If you've never been a Stockcharts member, I would encourage you to consider it today because we're giving you a sale. We normally only give sort of on that Cyber Monday type of time frame. We're giving you that sort of experience right now in the middle of the year. So make sure you go to stockcharts.com/special or scan the QR code that you see on your screen. By the way, if you're a current member, you get an even better deal. So make sure you go to that website or scan the QR code. Extend your membership today. I want to welcome on today's guest, Bret Kenwell. Bret's the U.S. Options and Investment Analyst at eToro, based in Michigan, but today coming to us from California. Bret, first time on the show. Can't thank you enough for coming on and sharing some perspective with our Final Bar users and viewers. How are you these days, okay?
Yeah, I'm doing great. Thanks so much for having me.
No, it's a pleasure to have you on, and I appreciate what you guys are doing at eToro. I'm excited to get some sense of where you're at as we're sort of in a transition phase, I guess, for lack of a better term. We're looking at your weekly chart of the S&P 500. Obviously, April has been a very dramatically different month than the first 3 months of the year. When you look at this current pullback, where are you at? Sort of describe your perspective on the current conditions.
Yeah, so, I think when corrections come, it's really easy to get get a little startled, get kind of scared. For us, we've really been trying to stick to the mantra of being optimistic but realistic, right? So the S&P is working off 5 straight monthly gains. back-to-back quarterly gains of 10% or more. So it's been a really powerful move off the October lows. And the S&P rallied 28.5%, I believe, from those lows to the all-time highs. So a 5% pullback, that seems pretty reasonable to me. We're trying to carry that mindset forward and viewing the 5% pullbacks are normal. We get about 3 pullbacks a year within that magnitude. And so the 5% to 10% dips, we're looking at that constructively, and it's possible that things change around, but for now we're looking at it as optimistic. The 5,000 area is a key concern in terms of regaining it and staying above there. But even if we were to go a little lower, I wouldn't really hate to see the 4,750 to 4,800 area retested. That'd be the prior all-time high from the last bull market.
Yeah, and it's interesting. I mean, we're pulling back in your chart to the 21-week moving average, and for now appearing to stabilize here. At a higher level, Bret, how do you differentiate from sort of a garden variety? This is a normal pullback, and to be clear, we haven't had one of these in a while, so I think it feels abnormal, but it's totally straightforward. How do you differentiate one of those kind of more viable pullbacks versus something that's really starting to deteriorate? Is there a particular signal or pattern that would tell you, we need to get defensive? What would you look for here?
Yeah, it's interesting. I actually think it'd be the rebound is what would be telling to me.
Okay.
Can we reclaim some of the key levels? Can we get back above? We're on a weekly chart here, but can we regain the 50-day? Can we get back above and stay above 5,000? Can we start to take out some of the prior weekly highs? The market gave us about 3 weeks of topping out at 52.60, somewhere within about 10 points of 52.60 for multiple weeks, and then it rolled over. I want to see what it's like on the rebound. Can we reclaim some key levels? Can we start to take out the prior week's highs? Or is prior support going to be resistance? And are we going to start pushing back into the recent lows? And that's sort of how I'm going to interpretate the price.
That's a really good point. No matter what, whether this is a longer decline or a short decline, we're going to have that bounce, and what happens during that bounce, pretty key. It's a great point there. Energy, the XLE is the second chart that you have. Again, a weekly chart. Certainly seems like we're breaking out of a pretty decent level here recently. What's your take on energy here?
Energy has been robust. It was the best performing sector in Q1, very quietly. I believe it ended the quarter on a 7-week win streak. And so far in Q2, it's remaining the best performing sector year to date. So that strength is staying. And as you just pointed out, the chart illustrates really cleanly the breakout we had to new highs. It's a multi-year breakout. It's a very significant move. And so far we're dipping back to that breakout level and we're holding it. It's not a lot of wiggle room, which can make it a little tougher for swing traders. But for now, energy's holding that mark. I want to see it keep holding it. And if it can, energy could continue to be a leader going forward through the rest of the second quarter.
It's one of those great time frame exercises. I feel like if you have a daily chart of energy, it feels very overextended recently because of the run. The weekly chart really shows the magnitude of this base that we've kind of broken out of. It's a great way to show that. Now, we have a lot of earnings coming up through the course of this week, Bret, particularly some of the leading mega cap growth names. Apple is a stock that has certainly diverged from some of the others, rotating lower along with Tesla. Is Apple entering a point where a particular level where it would make sense to start to nibble a little bit?
Yeah, Apple and Tesla are feeling like the disappointing 2 rather than part of the magnificent 7 at this point. It's been a tough start for bulls in both of those names this year. Obviously harder in Tesla, but yeah, Apple kind of uncharacteristically, nearing this 20% pullback area. It's obviously working through some of its own company-specific hurdles, and the stock is reflecting that, right? They have earnings coming up. Is that a chance for the stock to kind of hold these levels and retrace some of the losses and get back on the horse and rejoin its peers in the rally? Or is an earnings more of a risk and going to open up some of those lower downside levels? And it's always so tough going into those earnings reports to speculate on the outcome. And I've been looking at the chart for the last couple of weeks. It's kind of floating around that fourth quarter low, that it's just kind of hanging around there. And I would love to see it come a little lower, just flush down into that low 160s in there. You get the 50% retrace all the way back down to the to that 2023 low and retest that prior downtrend line. I don't know that we'll get it, but I would love to see it. And and at least gives traders a good risk reward level to, stack their chips a bit.
How do you think about a name like Apple coming into earnings? There's obviously a lot of earnings risk. It a lot of times can be a binary outcome, right? It shoots up, shoots down. Do you tend to, I mean, I know I've spoken to some who are sort of earnings agnostic. They say the chart's going to reflect what it does, so just focus on the levels. Or do you tend to make changes going into earnings to try to alleviate some of that earnings risk? How do you sort of play through a name, obviously in a pivotal earnings report here coming up?
Yeah, the answer is kind of a blanket statement in a way, but it really depends on your time frame. Are you
Yeah.
trading this name or are you investing in it? And the S&P, when we talked about that, we looked at it on a weekly view and it looked very clean and very orderly and would make you say like, what is anyone worried about right now? But if you're in there on the daily or the intraday time frames and S&P's down 6 days in a row and it's already coughed up hundreds of points, it feels a little bit different. Feels like you're on the battlefield a little bit. And so I would say the same thing with Apple. If you're investing in this name and your time horizon is quarters or years, I wouldn't be all that worried about it. If I was trading it, on a short-term basis, I personally don't like to take a position ahead of earnings just because the
Mm.
situation is too binary. But I think time frame is the most important question for that.
Yeah, it's so funny how many times investors and traders make decisions using the wrong time frame, right? So I think that's there's a lot of investment wisdom in those comments there, Brett. Now, semiconductors, obviously one of the top groups going into the last 6 to 8 weeks, all of a sudden showing vulnerability along with a lot of other stocks. AMD has been pushing steadily lower. What's your take here on this daily chart?
Yeah, AMD was one of the top chip names in Q1. As you guys know, artificial intelligence, semiconductors, that was a huge focus in Q1. NVIDIA was the top dog, but NVIDIA was the top dog, but AMD is always getting attention as well. But very, very quickly, we've seen the stock unwind 35, 36% off those highs. Those highs were not that long ago. And so I'm kind of looking at this as possible opportunity. Ideally, I'd love to see it work its way down into that 130 to 140 zone. That was a prior resistance level, most recently support, and then the 200-day moving average is in there too. So I would love to see, I think that'd take it about 40% off the highs. I'd love to see that kind of dip and just give me a cleaner buying setup right now. Conversely, as you see, it's bottoming a little bit ahead of it, which can be frustrating. It kind of gets a little bit of the FOMO going. Just you don't want to feel like you're going to miss it, but you also don't want to get caught if it's coming down another 15 points. So I'm watching the downtrend line as well. If it can break out over that, maybe bottomed a little early and it's going to get going again.
It's interesting. A lot of these chip names and some of the other leading growth stocks obviously have had incredible runs. Now starting to pull back, and I would say on the other hand, we've seen energy materials, even industrials at times, really starting to resurge. There seems to be part of this larger rotation of sorts with some of those other sectors starting to do well. Are you seeing that rotation in your work, sort of away from some of the growth into more of the value, or are you seeing that this sort of pullback in names like AMD and Apple may just end up being a really good entry point to the next leadership move higher?
That's a great question. When we were in 2023, mid 2023, so go back almost a year ago, we had fairly narrow leadership, right? We had the Magnificent Seven and like Eli Lilly, so like the Magnificent Eight, if we want to unofficially, loop them in as well. But they were such strong leaders, and the Nasdaq was a powerful performer. And then we had, volatility through Q3 and into late October. But it was that late October rally that we saw drive all the way through March. So about 5 or 6 months, about a little over 5 months of rallies. The sector performance and sector participation was really, really robust. Breadth was really strong. I believe in Q, I don't know the numbers I can't remember off the top of my head, but a good handful of sectors in Q1 were up more than 8% or more. So it was really not just this leadership from tech or the leadership from the chips. It was really across the board, and it was great to see. Obviously, this pullback has kind of shaken things up a bit, and some of those sector gains have shrunk quite a bit. But I'd say the breadth overall, the last 3 weeks have been a little touch and go, but the breadth so far this year has been a lot better.
We'll have to keep an eye on that. And listen, Brett, this has been fantastic. I can't thank you enough for coming on. I'm glad we've done this for the first time. I hope this is not the last. We look forward to checking back with you later this year, seeing how some of these charts have evolved. But thanks so much for coming on today.
Thank you so much for having me. And likewise, I'd love to be back.
That's Bret Kenwell. Bret's the U.S. options and investment analyst at eToro. I tell you what, I love the fact I often, anytime someone comes on, I sort of give them an opportunity to share whatever charts they think are meaningful, and I find that often leads to some really good discussions. I love when someone like Bret comes on with the weekly charts. I feel like as the market's rolling over, it's so easy to get sucked into the daily, the hourly, the really minute, minute-to-minute, what I call the flickering ticks of the market. He's bringing weekly charts to try to put this decline into proper perspective. So I think a great lesson there, a great take by Bret Kenwell of eToro. Folks, that's it for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Special thanks to Bret Kenwell of eToro joining us with some thoughts today. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.